Welcome to TMS Insights. We're into August and that means reporting season. Most of the full year results for 2017 are coming out, so we're pretty busy here and the shirt sleeves are rolled up. Ben Clark and Jeremy Hook bringing you some news, and let's go straight to a big report that came out this week, Ben, Commonwealth Bank, that followed really, quite big news in the mass media about the AUSTRAC fines that CommBank may be heading towards.
Yeah, I mean, obviously pretty disappointing, the scandal that broke. And I think the biggest disappointment about it, Jeremy, was how good a quality the result was from Commonwealth Bank. And quite unexpectedly, it is a tough time to be growing your profits in this environment as a bank. But CBA delivered cash earnings per share up almost, actually a bit over 7% versus market expectations of mid-fives. And also increased the dividend, which was not expected, and they increased that dividend 8 cents. It wasn't even a small increase. And, I think it was actually a really good quality result, but disappointing that we've got this scandal, which I think will work itself out. I don't know. What are your thoughts on it?
Look, I think these things delight the popular press in terms of how the market will react to it. Ultimately, it'll be a one-off. So one-offs rather than ongoing issues for earnings tend to be discounted by the market, and they're far more interested in how future maintainable earnings will be. And in that result, like you said, Ben, the signs were more positive and gave an upbeat outlook for that company going forward. There will be some ramifications about this particular scandal, and it's not good. The worst of them for mine would be a banking sector issue in the form of, will there be a Royal Commission? And the odds do shorten after and other factors like that.
Good use of shorten.
No pun intended. Just one thing that they did announce was on their insurance businesses, which haven't been a great part. But at the same time too, reports this week from both Suncorp and AMP highlight the weaknesses and plans to dispose of insurance businesses as well.
Yeah, and particularly life insurance. And, although we don't own AMP, we did listen into the result yesterday, and Craig Meller, the CEO there, really a big point he made that stuck with me was that the seriously big life insurance businesses, and we're talking Munich, RE and Berkshire, are happy to generate a lower return investment than we are locally.
Yep.
And therefore, these are huge behemoths, and they're willing to make less money, and therefore it gets very hard, I think, for the local insurance company. You don't have the scale and are trying to make a better return. So, the AMP result again, I think, sort of underwhelmed, and Suncorp are clearly struggling with some of these issues as well. And it would seem that the move is to sell these divisions. I think they're giving up on operating life insurance businesses in this country.
Yep, and that is a sign of the times. These things go around in big cycles. Let's talk about a result just out this morning, which was of real interest to us, noticing REA Group. Now, that's been a stock we've liked for a long time. It's been a really good stock, but it was getting a little expensive, and the result, while good, didn't please the market at first, Ben. Yeah,
it's a highlight for earnings season so far has been some wild share price reactions to news. Look, I thought REA has again delivered a very good result given the environment that they're operating in. You have to put it into perspective that listing volumes in FY17 were down 5% versus the previous year, and they still managed to grow their earnings per share by 12% in that environment. So to me, that's a great set of numbers in a difficult market, but we know that environment eventually will turn, and there was some talk on the call with the CEO that they are seeing signs of that potentially happening. And if the housing market, particularly in Sydney and Melbourne, is slowing, that should lead to greater number of listing volumes, which will see a re-acceleration of that earnings number. So I think it's a hold, but you've got to look at valuation as well. And at $70, it probably got a little bit overloved. Yeah. But trying to trade it, I think, is a mistake at the same time, because this is a business that we still see great long-term prospects for. Yeah, tight share register, and again, those sort of wild swings that you get. We saw a wild swing
with a number, well, like you said, Ben, a number of companies, but let's go to a company not totally dissimilar that reported on Wednesday, which is car sales, and its first day reaction was quite different to what happened yesterday on the Thursday. It's the day after, which was a very rapturous applause from the market as the stock almost touched 12-month highs.
Yeah, I mean, I think at one stage it was sold down 7% on the back of its result. And we listened into that as well, and it was a solid without being great result. I couldn't see any reason for the weakness in the price, and then. Post that, the stock I think has risen about 17% from that opening kind of level.
Amazing.
And is now actually I think hit an all-time high. So I think one thing clients probably trying to get their heads around these moves need to understand is that the market is presented with 80 pages of financial information that it needs to digest in almost 30 minutes to make a decision on whether a share is cheap or expensive. And different people will look at different things and take different viewpoints. But as long as that earnings trajectory is continuing over time, the market's efficient. But in the short term, you can see some moves which are virtually unexplainable.
Excellent. A good take on how that is. It is a complicated time, and you do see these wild swings. A couple of other stocks that have reported. RIO last week was, a reasonable set of numbers, but didn't quite hit market expectations. So they actually suffered a little bit on the back of that. How do you see RIO, Ben?
Look, I think it's a business that's going to be spitting out a fair bit of cash back to shareholders over the next few years. The balance sheet is now at the lower end of their gearing guidance. It's a very stable business, I think, now, Jeremy. The share price will be dictated by what the iron ore price does ultimately, but there should be good returns to shareholders coming through.
Good dividend increase this time, so that was good. And yesterday, Magellan Financial Group, which has been a well-performed stock over the last little while, but didn't provide the earnings growth to kick the share price along. But still some quite interesting stuff in that conference call, Ben.
Yeah. Look, the underlying earnings per share were up 15%, which was good, but they didn't earn the performance fees last year that they had the prior year, so that made the numbers look a bit soft. But I guess the big news is this big new global investment trust that they're going to list onto the stock exchange. And, it's quite amazing. The analysts can't quite believe the generosity, I guess, that the company is giving to new investors. You have to be either a Magellan shareholder or invested in a Magellan global fund. And you'll have the ability to invest $30,000 into this new ASX listed fund. But Magellan are literally going to write out a check for a 6.5% loyalty bonus. And they're also going to allow shareholders to reinvest dividends at a 5% discount to the unit price, and they will pay for that.
Very impressive. Very
amazing.
Very generous, but also too they're going to pay for the costs of the issue rather than get you as a new investor to do that, which stands them out from a recent group of LIC listings as I think very ethical and generous. I like it.
Yeah.
Ben, let's get into one final large issue that's affecting the market today and has been over the head of the market for quite some time, North Korea. Heated words to end the week between both the US and North Korea. Just a few comments, I guess, to get the client psyche right as we go into potentially a destabilising period.
Yeah, I mean, we've had... little short, sharp issues with Korea for over a decade, more decades now. And it's not, I think the first thing I'd say is that making investment decisions on a geopolitical risk that none of us can really accurately sort of determine what's going to happen is a mistake. So asset allocation, of course, is always important during these times, and having the ability to take advantage of weakness in markets if it were to occur is also very important. Ultimately, Jeremy, my view is that this will catch media attention for some time and then it will simmer down. Could be wrong, but if I look at the US market in particular, They haven't had a 5% correction since November 2016. And I think that's the second longest run in history that the US market hasn't had a 5% correction. So my sort of thought is that they are due for a correction.
Sure.
And this issue, whether it's warranted or not, could be the reason that that market corrects.
Just an excuse that the market looks for sometimes to do what it normally does, which is take a breather.
Yeah, and a healthy thing. You actually want to see regular corrections in markets, otherwise inevitably pressure builds up and the correction that does occur is larger than you'd like to see.
Yeah.
But, US has also just gone through their earnings season, and again, it was very strong.
Good numbers, very good numbers. And that's what matters most, valuations and earnings outlook. So we're hearing more of these companies report locally, and that's what's keeping our eye on the market and keeping us busy. We're going to bring you more earnings data later in the month, but that's all we've got time for today.